if arbitrage did exist, that would mean that the other 95% of your strategies would be at not a loss, but a disadvantage, because that would mean that there was illiquidity in the market. Like arbitrage only exists in markets that have, just not the standard of liquidity that like, you're not going to find any arbitrage in any variation of the S&P 500. It's not going to be there. Like if it's there, your eyes literally aren't going to be fast enough to catch it, and you don't have enough money to make any profit off of it when you're talking about that basket of 500 of the largest stocks on the planet against the most looked at index and the futures and ETF and everything on top of it and all those options.
I guess the best way to put it is like arbitrage it used to really exist when somebody knows something that nobody else knows. And that day is definitely pretty much gone. So to your point, you really have to have a lot of money and be a big institution or something like that to be able to maybe pull it off.
What's interesting, though, small exchange products made for retail people and made for just everyday investors and traders and hedgers and everything else out there. And since these markets are so new, and so not necessarily, it's funny, I was going to say the word niche, but it's funny that it is a niche audience in terms of like the larger financial landscape, but that niche audience is the majority of people on the planet. And that's just like the funny dichotomy of finance, which is like, oh, it's niche to market towards everyday people. It's mainstream to market towards big banks. And it's like, man, something's wrong there. But anyways, I digress. I don't need to get into that. But since these markets are so new, Jermal, there is arbitrage to the tune of a few bucks that presents itself every once in a while in these markets, especially when a new futures market from the small exchange is launched. And you also see this in like CME launches as well. Like when a market's fresh and new, and there aren't that many market makers in there, there are not that many eyes, you'll get these periods. Like when we launched the small crude oil, you'll get these periods where like small crude oil is at $70.50 and the big WTI crude oil futures are at like $70.60 or 65. And it's like, oh man, if I buy 10 of the small crude oils and sell one of the big crude oil contracts, like I did just theoretically lock in a nice $150, $100 profit there. And that goes away pretty quickly after you launch a product, but look for it for our next product that we launch. But I do want to talk about futures role and where there could be arbitrage. And we talked about this earlier this week, these two ideas to kind of get us kicked off on, to start thinking about where there might be an arb in the futures role. Now, first, this futures role mainly used to extend duration for active investors. The same as options and in futures, right, Jermal? Maybe you want to give a quick, 30, 60 seconds on just like what role is for derivatives.
Futures role is the idea of being, or just role in general, is be able to extend your position out from the current expiration to a different expiration or the next expiration ahead. And in this case, what we just had, what we currently are still in with another day is September U futures for many of our products. And we're going to be rolling to October, if you haven't already, V or October futures for the next month products. So with that, I have one question for you beginning at the end. I know obviously the latest we can roll is tomorrow, right?
Yep.
Otherwise settles the cash, which again is it's a good thing. It's not like we had to take a position or anything, which is nice. What's the earliest somebody should look to roll?
Great question.
And what's the perils if you roll too early? So let's talk about those two things.
Absolutely, because I actually got one of my followers on Twitter. He was just asking about this last week, and he was like, because he rolled last week, and he was like, I think I just lost like some money rolling this thing because there wasn't great liquidity in the deferred month. With small exchange products, you want to wait until that week of expiration. So if expiration is on Friday of next week, it's too early. If expiration is Friday of this week and it's Monday, Tuesday, Wednesday, Thursday, or even Friday, that is optimal time for rolling, because and it's not the end of the world. Small exchange products are so small and they are still decently liquid in the deferred month that like the guy who posed this question was like, At the end of the day, I gave him all the information, and he lost $10 rolling too early, which I still, hey, that's $10 you shouldn't lose. And I don't want anybody to lose $10. But it is the idea is before that roll week, our market makers aren't in that inactive deferred month. And so you essentially will have a market in September that's 1, 2, 3, 4 ticks wide. And then you'll have the deferred month that could be, 5, 10, 20 ticks wide. And when you go to roll, say you're long a future here, you need to sell the old contract and it's 2 ticks wide. Oh, okay, so I lost no money because the market is right there and I got everything done. But now I need to buy that new contract. And if I reach 10, 20 cents higher because that's where the offer is and the market makers aren't in there, then yeah, I've lost 10 or $20 on that roll. Great question there. And I think we've covered a little bit of that futures roll. If you haven't already, roll your futures from SEP to OCT, like our good friend Jermal just said. Now, if you have no futures, I want to talk about something that could be out there in terms of arbing the futures against the index. We see, and remember that the two ideas that we talked about were small exchange futures settle to cash, which is very nice, very clean. In terms of futures, that if I'm an everyday trader, a retail trader, that's what I want is cash settlement, because when the trade ends, I just get the money back in my account and I don't have a physical position in that market, which is very costly and could be risky there. Cash settled futures teamed with the idea of a future is quite literally just where supply meets demand, where buyers meet sellers on the future price of any asset. And so if we have pot stock futures like we do at the small exchange and they've moved lower, and a lot of people use that market to just get long investment at a cheap price, you would maybe expect that the futures be priced a little bit higher than the index just because there are more buyers in the futures than sellers. Now, here is the layout, September 10th to September 15th, which is just yesterday, of the September futures relative to the S420 index price itself. The spread went from positive 3 cents futures on top of index to negative 10 cents in 5 days. Now, that's not a lot of money, but that's $13 per contract there. What happened there, Jermal, is a lot of people are long going into the roll and the futures are trading a little bit on top of the index. And now that it's time for expiration, everybody thought those futures were going to be higher than the index, and they thought the index would move higher to meet them. It didn't happen in this expiration. So a lot of people have to sell those September futures to buy the October futures. September futures move lower. Now they're actually under the index itself. Are you starting to feel where there could be potential for, if I had no futures exposure whatsoever and I saw expiration is looming and these futures are higher or lower than this cash settled index here, what we could be looking at?
Yeah, I mean, given this example, this is a situation, and again, I think we touched on it, the idea that you're talking about getting to the idea of that at expiration, this future will settle to the index, correct? Yep. So being that there's a 10-cent difference, that $10 or whatever, you could potentially look to buy the index with it trading under, with the assumption that eventually it'll settle into the index. Is that correct? Is that kind of...
That's exactly right. So like the idea is whether there's more long interest or short interest, and thus the futures are above the index or below the index going into expiration. The central idea that Jermal just hit is as we approach expiration and the index is what the futures cash settle to, I don't have to worry about physical delivery or anything. If all else equal, I bought those 914s and it's Friday at 3 p.m. and the index is 924. If I have those 914s, my account's just going to get debited $10 per contract there. And this is with the caveat, some brokers will give you an exercise fee. I am fairly confident that Tastyworks doesn't do that. And I know for a fact that the small exchange doesn't assign any other fees for you carrying that position into expiration. And so, yeah, the idea there, Jermal, is that like if it's 259 and the futures are 10 cents lower than the index, I do have essentially $10 if all else equals and it goes out that way. Now, of course, you're going to, especially if you're looking out days in advance, you're going to want to hedge it. And like I say, the real cool idea here is if I have no futures exposure and I don't need to roll anything, I'm just looking at this market from the idea of like, there are thousands of people out there who are either, long or short this product, and that long and short demand and supply has converged to create a situation where the futures are above or below the index. And I can kind of, with no liabilities in this market, I can kind of trade that thing around the index with the idea of, as it gets closer, maybe not hedge the risk. But if I'm days out, I could hedge and kind of lock in a few bucks of profit every time I see, maybe a 10, especially if you're starting to see 10 or 15 cents worth of difference between the futures and the index. That's where you really might see ARB in such, and it exists here because these futures are so young and new. There's a lot of people out there trading them, but we only have a couple of market makers keeping these things in line, especially around the roll. It's this idea of like a lot of stuff's going on. A lot of people are looking to roll. The market itself is moving. Not a lot of people are necessarily keeping the futures in line with the index. I mean, is this starting to make some sense?
Yeah. I mean, as we sit here, a whole host of things came to my head because, of course, this harkens to the idea and options of expiration with options, which is, quite the process. I mean, nobody wants to deal with it. It's baptized by fire when you're first learning to do it as a trader. And, so the idea is that you just want to get away from that situation. You don't have the ability to do anything like that because, first of all, option markets are usually wide. Everybody knows what they're trying to do. And so you don't have the ability to do that. And even if you did try, you run the risk of coming in Monday morning with a stock position, which is definitely what you won't do. Yeah. Versus here, like we've already said, the best thing about it is that it settles the cash. So even when you try to make this type of trade and you end up doing it, so you end up buying those SEP futures on Friday afternoon, I mean, you're going to settle into cash. So you'll be fine. I mean, like overall, there's, like you said, there's no liabilities, if you will. And the best part, we don't have an exercise cost. So this sounds like a do to me.
Absolutely. So like, now here's the idea though, with all of that, like the concept is very cool. The opportunity is out there and you can monitor it relative. Cause I have gotten so many emails of like, hey man, like the index is trading at $10 even and the futures are at 10.05. What's up with that? And it's like, if you're weeks away from expiration, that's just term structure. That's just like where, like I say, supply and demand meet. And in the next couple of weeks, like the market might go to like, look at SPX and ES, any expiration, it's going to differ. And that isn't necessarily arbitrage. That's like the legit term structure of where, given interest rates and a bunch of other things, where they expect that market to be in the future. Now, as we approach expiration and interest rates affect and all of those different things kind of diminish because it's just, man, we're hours out or a couple of days out. That's when this opportunity tends to arise. Now, of course, you can tune in at 1:30, 2 o'clock, 2:30, 2:58 and try to clip a couple of bucks off of trading the futures against the cash settlement at the end of the day there. That is, I mean, I knew people when I was at the Board of Trade whose sole job was trading the roll. They would show up. I would see them once a month because they would show up to trade the roll that week, and then I would never see them again. Yes, you can look into that, but there are risks associated with that, right, Jermal? Like, of course, market could be back in this scenario here. Index is 9.25. Futures are showing 9.14. And I'm buying. If pot stocks get slammed in the last 5 minutes, you're going to get hosed there. Like that is risk. That is very real. And so what we can look at doing, the exact ratio for S420 is 63 shares of MJ. And these two move very, very similarly. Like the correlation is above 0.9. It's a pretty decent hedge in here. And the nice thing about this is you could look at, like if there's a 10-cent difference, and I buy 1 or 2 or 3 of these S420 contracts, I sell the shares of MJ. We have gotten to a point here in 2021 where fees and commissions are so low that you could, $10 per one lot is actually feasible there. And it's a fun exercise to kind of a different thing to look at here, arbitrage in the market. But you do want to see that these risks are very real, that the market could fluctuate in those last minutes, and especially if you're doing this days out. But I do like adding the hedge here. And what's nice as well is that you can carry that future into expiration and get rid of those shares, right at 2:59, 3:00, and get out. Hopefully, at the end of the day, what you hopefully do is scratch those shares and just let that profit come in from the futures expiring to cash. Is this all making sense? Are we at a good closing place here?
We're at a good closing place. I think I'm definitely picking up what you're laying down. I like it. And presenting the idea of MJ to be able to hedge. So for one, we're saying for every 163 shares of MJ, we get one S420, correct?
That's exactly right. So yeah, okay. And this works. This isn't always, futures under index. It works for if the futures. And what's really nice about this, like I say, is when roll comes in, and there's just like a lot of stuff going on. The market itself is moving. There's a lot of stuff going on. And like someone comes in, say, and they need to roll 200 S420 futures, and they are selling out of that position. And it's sell. Essentially, you're buying a couple of those from that person who's kind of price insensitive. They don't really care. They're just, or price indifferent. They're just trying to get rid of that and roll out to the next month. Same with like short futures. They come in, buy. You essentially want to sell a couple of futures to them and then hedge with the 63 shares, just doing the opposite position. So that's arbitrage. That's futures roll. Hopefully we get some real examples of it going into the close this week. At very least, everybody out there, watch it and kind of see how it's really cool to see how these futures go into that final settlement. And what's nice is that the small exchange futures are so small that, of course, there's risk in every trade, every product, but you're talking about between 255 and 3:00, $10, $20, $30 per one lot is the usual movement in there. So it might be worth trying out your hand at arbitrage and the futures roll. Well, Jermal, thanks so much for joining me here, man. This has been a blast. We must, though, move on. You can move on to the weekend or whatever you do on Thursday and Friday and everything else. I don't know. I'm not in charge.
I got really no plans this weekend, which is kind of nice. Last couple of weekends been a little busy. I got a couple of kid games here and there, but that's about it, man. I mean, you got some stuff going on, right? Aren't you hitting up a game or something like that, from what I understand?
Too much stuff. I saw my White Sox lose last night, but
I didn't get to see
Ohtani.
Oh yeah,
it was funny. I saw Ohtani play and for the Angels, and it is really cool to see like when he comes up to bat. He did nothing the whole game, but he comes up to bat and like everybody shuts up. And to see that is really, really cool. It's got to be like, being around. Obviously, no one is Jordan, but like being around, like if Jordan's in town, it's like, no, everybody's taking this game seriously, and everyone's standing the whole time and watching it. It was very cool. They lost. I got Riot Fest tomorrow. I've got Dead and Company on Saturday. It's going to be a full weekend of music. But anyways, no one cares about that. They do care about Pete Momet splashing the futures. Hang out, everybody. A lot of stuff moving. We got a lot of trades for you. See you in a few. Thanks for watching.